The Dollar's Dilemma: Untangling Domestic Policy from Global Trade with a Trade Dollar by Ungsu Kenneth Park. The US dollar holds an unparalleled position as the world's dominant reserve currency, bestowing upon the United States what former French finance minister Valéry Giscard d'Estaing famously termed exorbitant privilege. This privilege offers advantages such as lower borrowing costs for the US government and easy financing for international transactions. However, as recent economic cycles have starkly illustrated, this privilege comes with an exorbitant burden, creating an inherent conflict between the needs of U.S. domestic monetary policy and the liquidity demands of the global economy. This tension presents a formidable challenge, particularly for ambitious national initiatives, like revitalizing domestic manufacturing and achieving widespread reshoring. When the U.S. Federal Reserve acts to cool an overheating domestic economy through measures like quantitative tightening, QT, and interest rate hikes, its primary goal is to tame inflation and ensure price stability within the United States. However, these very actions, by making dollar-denominated assets more attractive, draw in vast amounts of portfolio investment from around the globe. This influx of capital effectively injects liquidity back into the U.S. financial system, often mitigating the Fed's intended tightening effects and contributing to inflated asset markets. It's akin to attempting to drain a bathtub, while external forces continuously replenish it. This capital inflow also has profound implications for domestic industry. The heightened demand for dollars strengthens the U.S. currency against its peers. While a strong dollar makes imports cheaper, which can help curb inflation, it simultaneously makes U.S. exports more expensive and less competitive on the global stage. For companies contemplating reshoring manufacturing operations to the United States, this currency disadvantage adds a significant financial hurdle. When it's cheaper to produce goods abroad and import them, the economic incentive for domestic production diminishes. This suggests that achieving a robust revival of American manufacturing, as envisioned by movements like Make America Great Again, MAGA, may become impossible unless the U.S. fundamentally reinvents its production technology. With advanced AI and automation, rather than just innovating product design, to overcome the persistent cost disparities. While central bank swap lines and facilities, like the FEMA repo, provide crucial stopgap measures during acute global dollar shortages, they are temporary solutions to a systemic issue. They address symptoms, not the root cause of the conflicting demands placed on the dollar. The proposal, a trade dollar for a decoupled global trade system. To address this persistent dilemma and cut the tail that wags the body, a bold new approach is warranted: the creation of a trade dollar, a distinct digital currency, specifically designed for international trade and as a global reserve asset, entirely separate from the domestic US dollar. How it works. One Ishawari, a new global currency. A trade dollar is established as the primary unit for international commerce and central bank reserves worldwide. Its value would be pegged to the US dollar to maintain stability and familiarity. But its supply would be managed by a joint international body, comprising representatives from major global economies, including the United States, who appoints the Secretary General to decoupled supply management. Unlike the domestic US dollar, whose supply is dictated by the Federal Reserve's mandate to manage the US economy, the trade dollar's supply would be calibrated based on the actual liquidity needs of global trade and finance. This international body would ensure adequate liquidity for cross-border transactions and reserve accumulation, independent of U.S. domestic inflation concerns. 3-point differentiated payments. O exports to the USA, payments for goods and services exported to the United States, would continue to be made in real dollars. The domestic U.S. dollar directly impacting the U.S. economy as it does today, or overseas asset building. To manage destabilizing capital flows and prevent the boiling up of U.S. asset markets, overseas entities seeking to build substantial, long-term asset portfolios within the U.S. using real dollars could be subject to specific fees or penalties. This aims to disincentivize purely speculative or excessively large financial inflows that undermine U.S. monetary policy objectives. If Gresham's law works and real dollar carries a premium in the money market, then that will set the ceiling of this penalty. If the USA economy is slower than the rest of the world, which is highly unlikely, the penalty can be cut down. Potential benefits of a trade dollar. This two-tiered system offers compelling advantages. For the United States, The Federal Reserve could focus more purely on its dual mandate of maximum employment and price stability within the U.S., without the constant pull of global dollar demand or the counteracting effects of capital inflows. This autonomy could make domestic policy tools like QT far more effective in cooling inflation and asset bubbles. Crucially, by reducing the currency-induced competitive disadvantage, it could create a more level playing field for domestic manufacturing, making genuine reshoring efforts economically more realistic. For global trade instability, international trade would benefit from a more stable and predictably supplied currency, reducing exchange rate volatility and financial instability that often arise from U.S. domestic monetary policy shifts. It would also create a fairer, more diversified international monetary system, reducing the exorbitant burden on the U.S. to act as the world's sole liquidity provider during crises, challenges, and the path forward. Implementing such a profound shift in the global financial architecture is undeniably fraught with challenges. Concerns over national sovereignty, establishing trust among diverse stakeholders, devising a robust governance framework, and ensuring broad market acceptance would be immense hurdles. Yet the growing contradictions of the current dollar-centric system, highlighted by economists like Barry Eichengreen, in exorbitant privilege, and central bankers like Zhou Xiaochuan, with his calls for a super-sovereign currency, demand bold rethinking. The IMF's ongoing work on capital flow management, such as et al. 2010 and the Bank for International Settlements into multi-CBDC platforms for cross-border payments, such as Project Dunbar, already lays some conceptual and technological groundwork for such a vision. Mark Carney, former governor of the Bank of England, also articulated the need for a synthetic hegemonic currency. To mitigate reliance on a single nation's currency, the current system, while resilient, is not without its significant friction points. As global economic interdependence deepens and technological capabilities for digital currencies advance, the conversation must evolve beyond stopgap measures to explore fundamental reforms. A trade dollar, managed collaboratively for the benefit of global stability, and allowing nations greater domestic policy autonomy, offers a compelling vision for a more balanced and resilient international monetary future.